Right now, a silent competition is underway. On one side, multi-billion-dollar algorithms and high-frequency trading desks process data at speeds humans cannot perceive. On the other side is a single person, sitting behind a laptop screen. For those entering this arena without a strategy, the statistics are grim. 90% of retail traders lose their capital within their first 180 days. This high failure rate rarely stems from picking the wrong company. It happens because beginners enter a high-stakes environment without understanding the underlying mechanics of the system they are trying to profit from. To join the 10% who survive, you have to identify the specific variables that professional traders control to prevent financial ruin. Without a deliberate system, a beginner's capital simply becomes part of the market's daily volume, transferred to more disciplined players through predictable errors. Consider two people who both start with $1,000 and the same market news. 6 months later, one account is empty, while the other shows a consistent upward trend. The difference lies in their priorities. The beginner who loses everything focuses on which stock will go up next. The professional focuses on exactly how much they can afford to lose if their trade is wrong. Successful trading is a defensive exercise in risk management, rather than a talent for predicting the future. Modern brokerage applications are designed to be frictionless. With one tap, a user can risk their entire savings with less hesitation than they would feel buying a cup of coffee. When trading feels like a video game, beginners often treat it like a casino. They chase social media hype and buy at price peaks, driven by the fear of missing out on a perceived opportunity. While excitement drives the crowd, the market only rewards execution that is disciplined and repetitive. Institutional desks do not need to outthink retail traders. They simply profit from the emotional reactions that lead beginners to buy high and sell low. Historical data shows that markets move in cycles powered by human emotion. Periods of optimism lead to greed, which eventually triggers a correction, panic, and a slow recovery. During the 1929 market crash, panic dominated logic. Investors sold their holdings at any price, resulting in a total collapse, as sheer human fear took precedence over the actual value of the underlying businesses. We saw the same pattern during the 2020 COVID crash. This chart shows the rapid plunge into fear, followed immediately by a steep recovery line that led to new all-time highs within months. Market volatility is a structural feature designed to transfer wealth from terrified sellers at the bottom to the patient professionals who buy during the dip. Professional longevity begins with treating a stock like a fractional piece of a business rather than a digital lottery ticket. This business owner perspective leads to the use of a risk-to-reward ratio. This is the primary tool Wall Street uses to protect existing capital before attempting to generate a profit. Risking $100 for a $300 target means you only need a 34% win rate to profit. Conversely, losing 50% of your account requires a 100% gain just to break even. That is an uphill climb beginners rarely finish. Professionals survive because they respect this arithmetic. They cut their losses immediately, while beginners hold on to losing positions and hope for a miracle. Transitioning into the top 10% of survivors requires replacing the search for overnight wealth with a documented, repeatable system. Start by securing your personal finances. Never invest money needed for living expenses. Then use a paper trading simulator for 30 days. This allows you to practice executing orders and experiencing losses without any actual financial damage. Once you understand the software, focus on index funds that track the broader market. This provides exposure to the growth of hundreds of companies simultaneously, reducing the volatility of a single stock. When you move to real capital, limit your exposure to 1 or 2% per trade and use strict stop losses. This ensures that no single mistake can deplete your account. By following these 5 steps, you replace emotional guesswork with a structured process. This discipline is the only proven method to avoid becoming another retail casualty. Trading is a professional skill that requires ongoing study and the patience to learn from every single mistake. The ultimate winners are not the people with the most complex indicators or the fastest computers. They are the ones who stay in the game long enough to let the power of compounding work in their favor. Achieving financial freedom is the result of deliberate preparation and ownership. You must decide whether to remain a spectator or to begin the work of becoming an owner today. For more insights into market mechanics, subscribe to Streets. Let us know in the comments, what is the first stock you are putting on your watch list? We'll see you in the next breakdown.